Yes, students. Now we will discuss the descriptive questions from May 2025 question paper. So before we start, I will just read out whatever instruction is given. Question number 1 is compulsory itself. Oh. Candidates are also required to answer any two questions from the remaining three questions. Working note should form part of the respective answer. This line is very, very important for the students because they will miss out this. All questions relate to assessment year 25-26 unless otherwise stated. Okay, sir. Question number 1. Mrs. S.C. Bose, aged 62 years, guys, important, age is 62, is a widow of a public sector employee who died during his service in 2011. She earns income from business of running a flower bouquet shop at Kolkata and income from royalty from writing books of science and sells in India and abroad. Okay, royalty income on books. Profit and loss account for the year ended 31st March 2025 for furnished by her is given below. One by one. First, let us analyze credit side. By sales of flower bouquet, 36 lakh 75,000 business income. Family pension from PSU through bank. Guys, this is taxable under IFOS. Income from other sources. Royalty from California University for books sold, 4 lakh 25,000. Foreign exchange brought into India. Guys, 4 lakh 25,000. See, it can be in both ways. In two ways. Either of the one you can do it. That is, you can consider this as a business income that is from profession. Okay, writing books is our profession and she is earning royalty. Can we consider this income under the PGBP, sir? Yes. Or else you can also take it under IFOs. Most of the time we consider it under IFOs, but you have both the options. You have both the options, and for this there is also a deduction available under Chapter 6A. Clear? Yes, sir. Next, dividend net figure is given 4,50,000, but while considering it under the head IFOS, we need to take gross. Sir, what is the TDS rate applicable for dividend? 10%. Then by interest on FD. FDR means fixed deposit receipt, 76,000, no TDS deducted, it seems. Okay. Closing stock, 1,36,000. Coming to debit side, opening stock 1 lakh, purchases 15,66,000, salaries and wages 4,90,000, expenses relating to books authored by her. Okay, can we claim it against it? Yes. Under whichever head it is taxing. For example, sir, if I am taxing this under the head PGBP, you can claim expenses also under the head PGBP. Sir, what if I am taxing it under IFOS? Then expenses also has to be claimed under IFOS. Oh. Expenses in connection with dividends. Guys, expenses, they didn't tell what is it. Only if it is an interest, you can claim it. Against dividend income, you can adjust only interest expenses. That is under IFOS. Maximum how much, sir? Actual interest or 20% of dividend income. Whichever is lower, guys. Repairs and maintenance, 3,25,000. Next, amount paid to IIT Chennai for scientific research projects. Guys, this is allowed only under optional scheme. If assessment is following default scheme, then it is blocked. Next, to computers and other electronic items purchased on 1st December 2024. Guys, it is a capital expenditure on which you can claim depreciation but not revenue. You cannot debit entire expenses. Okay, and purchased on 1st December, less than 180 days. Less than 180 days. Guys, whenever asset is purchased newly during the year, first observe the date. Check whether it is less than 180 days or more than 180 days. More than 180 days, full depreciation. Less than 180 days, then 50% of whatever is the depreciation rate. Net profit is 20,69,000, which we will take it as a base. Then additional information. Purchases include 2 lakhs related to flowers and creepers directly purchased from a farmer in cash on 26th September 2024. Guys, more than 10,000 is paid in cash to a single person in single day. Is it allowed or disallowed? Allowed. Allowed. Why, sir? Because if payment is made to farmer, it is covered in exceptions. Sir, for a farmer, can we pay it in cash? Yes. Guys, what you would have thought is, sir, section 40A3 is applicable. Yes, you have to check it because cash payment is more than 10,000. But under that, there are various exceptions. Yeah, one of the exceptions is if you have made the payment to farmer for purchase of any agricultural product, produce and all, then no problem. You can pay it in cash. If you want, I will just show you 1 second. So you can just come to PGBP. PGBP, profits and gains of business or profession. under that 48.3. Yes. So you can see this is 48.3. You cannot pay more than 10,000 to a single person in a single day in cash. But there are few cases where section 48.3 will not apply. Which are those cases? I will read which is the case which we are covering now. This one. F. Payment made to cultivators, growers, or producers for the purchase of agricultural or forest produce, animal husbandry products, products of dairy or poultry farming, products of horticulture or fish, products of cottage industry. So in this case, the limit is not applicable for cash expenditure, guys. Yes. So that means here no problem. It is allowed. Next, repairs and maintenance includes one-time deposit of 2 lakh paid to electricity and water department. Guys, this is not an expenditure. One-time deposit is not an expenditure. And most of the time this would be refundable. But question is not clear on that, whether it is refundable or not. But still, sir, the deposit, whatever you have kept, will not be an expenditure. Yeah, whatever monthly bill, electricity bill, water bill and all is there, you can claim it as expenditure. Yeah, but when it comes to deposit, it is not an expenditure. We need to add it back. Next, computer and other electronic items includes 1 lakh paid for television and washing machine for our household use. Oh, that is personal purpose. Now listen, guys, entire 4 lakh 50 we need to disallow. But while claiming depreciation, we can claim it only on 3 lakh 50. 3 lakh 50,000. How is it, sir? 4 lakh 50 minus 1 lakh. Minus 1 lakh. Okay, sir. Next. Salary and wages includes salary paid 2,40,000 to our illiterate brother. Reasonable salary as per market rate is 180. That means how much is unreasonable? 60,000. 60,000 is unreasonable, which is disallowed as per section 40A2. 40A2. Okay, sir. Next, she purchased a residential house for 110 lakh, for which loan of 75 lakh was taken from State Bank of India. Accrued interest was 3 lakh 37,500 till 31st March 2025, which was paid on 10th April. No problem. Guys, see, when you are paying interest for banks, 43B is applicable. You have to pay it within the due date of filing the returns. And this loan was taken for her residential house anyway. Okay, this is a residential house because 43B is applicable only for business expenditure. Clear? So this is our residential house. Okay, let us see. No principal amount and interest was paid by Miss SC Bose till 31st March 2025 because she paid it on 10th April. Okay. Ground floor of the house was used for shop and first floor was occupied by her residence. Now house has two parts, guys. Okay. One floor is used for business, another floor is used for self-residence. Clear? Whatever you have incurred for first one floor, you can claim it as business expenditure. Another will fall under IFHV. That is income from house property. She purchased an electric vehicle on 30th September 2024 for 25 lakh for business purpose. She can claim depreciation on this. How much? 40%. 30th September, na, more than 180 days. More than 180 days, guys. She sold 10,000 listed shares of SBCL Limited for 11,66,000 on 11th December 2024, which were purchased for 2,65,000 on 16th August 2024. Less than 12 months. So short term. STT was paid on purchase and sale both. So where is this covered, guys? 111A. 111A. No question of indexation and all. But observe the date of transfer. If they have asked tax, then we need to do that also. Okay. So what is the date of transfer? 11th December 2024, after 23rd July. So new rate would be applicable. What is the new rate, Mohan? 20%. Compute total income of Mrs. SC Bose under default tax regime under section 115 BAC and optional tax regime of Income Tax Act 1961. Guys, this is a question for 15 marks. As I have already told you, we have solved good number of total income questions. I have told you, sir, before reading full story, can we go read last two lines and come back for the story? Yes. Clear? So that while reading the story itself, you know what you are supposed to do. Clear? Yes. Under both the schemes, we are supposed to calculate only income. Only income, they have not asked the tax liability. Okay. Once we do one, the other one becomes easy. First, let us do it under default tax regime. Income from house property. Half of the house is used for self-occupied. No, that will be falling here. Self-occupied portion, that is first floor. Gross annual value will be nil. No deduction for municipal tax paid. No 30% deduction. Straight away go to interest. Straight away go to interest. Sir, whatever interest is paid, half of it obviously for self-occupation purpose. Yes, but it is a self-occupied property. No deduction for interest under default regime. Under default regime. Yes, sir. No interest deduction under default regime for self-occupied property. So what is the income from house property? Nil, sir. Then coming to profits and gains of business or profession. Net profit is 20 lakh 69,000. We are taking it as a base and making necessary adjustments. First, items of expenditure not allowable while computing business income. What and all is disallowed? Expenses relating to books authored by her. Guys, here what they have taken is the royalty income is taxable under the head PGBP. Alternate view is, sir, it is taxable under IFOS. If you consider that the royalty income is taxable under the head PGBP, then can she claim these expenses under the head PGBP? Yes, no problem. If this is taxable under the head PGBP, then this is allowed under the head PGBP. Is that clear? This is what they have done in this answer, but they have mentioned that we can consider this even under the head IFOS. Okay, now if you are considering this 4,25,000 under the head IFOS, then under the head PGBP, this is disallowed. This is disallowed and allowed under IFOS. Okay, sir. That is the alternative. You can see expenses relating to books authored by her allowed as deduction considering royalty income is taxable under the head PGBP. Note, guys, this note and all don't try to give it in your main answer only. Better give it separately. Clear? Here only they are mixed up. Note, royalty income may be taxed under the head other sources. In such case, expenses relating to books would not be allowed as deduction while computing business income, whereas it will be allowed as an expenses under the head income from other sources. Wherever income is getting taxed, claim the expenses there. That's all. Next, expenses in connection with the dividends. Not allowed since expenses is in respect of dividend and dividend is taxable under IFOs. Claim the expenses also there only. Then amount paid to IIT Chennai. Guys, contribution to outsiders for any research is disallowed under default regime. Under default regime. That is why we are adding it back. Sir, is it allowed under optional? Yes. Then computer and other electronic items, guys. Completely capital expenditure. Disallow fully. Disallow fully. But when it comes to depreciation, please take only 3,50,000. Where is depreciation calculation? Yeah. Only 3,50,000. Why only 3,50,000, sir? 1 lakh is used for personal purpose. So 4,50,000 minus 3,50,000. On that 40%. But as it is used for less than 180 days, you will take only 50%. Only 50% of it, guys. Oh, sure. We will continue. Next, payment to farmer exceeding 10,000 in cash for purchase of flower and creepers. Not disallowed under section 40A3 because it is covered in exclusions, guys. Clear? I already showed you that. So nothing is disallowed here. Next, one-time deposit to electricity and water department not allowed as deduction because it is not an expenditure. Clear? Yes. Because, and one more thing, they have not clearly mentioned that it is refundable and all. Assume it to be refundable. Clear? Because deposit most of the time it would be refundable, guys. Clear? Yes. Next, excessive salary paid to brother disallowed, guys. As per section 40A, to unreasonable payment made to relatives and associated concerns are disallowed. Okay. So 240 is paid, but the reasonable amount is only 180. Remaining 60 is disallowed. Then coming to items of income to be treated separately under the respective head of income. What are those? Family pension is taxable under the head IFOS, so we are removing it. And royalty, they are considering it as taxable under this head, so they are not removing it. Alternatively, I have told you, you can consider it to be taxed under the head IFOS and remove it here and include it under IFOS. Alternatively, yes, sir. So they are considering it is taxable under PGBP only, and they are leaving it here. Okay, so whatever royalty income she is earning is in the course of profession. Is in the course of profession. Okay, sir. Then dividends taxable under IFOS, so remove it. Even expenses be disallowed, even income you remove it and include it under IFOS. Then interest on FD also is taxable under IFOS, remove it, guys. Then allowable expenditure. Interest on residential house used for shop. One floor is used for shop now. Half of it can we claim? Yes. And for this we need to check section 43B because it is not paid within 31st March, but it is paid in the April itself. What is the due date? Under 43B, they have told due date of filing the returns. If interest is paid within the due date of filing the returns, it is allowed. So can we claim here? Yes, but only half because only half of the house is used for shop. Another half is self residence. Yeah, yes. So 168, 750. Then coming to depreciation. On this 3 lakh 50, I already explained. That is 4 lakh 50 minus 1 lakh into 40% is the depreciation rate. On that, we need to take only 50%. Sir, why 50%? Because it is used for less than 180 days during the previous year. Then on residential house, can she claim depreciation? Yes, only half. Because which is used as shop. What is the capital expenditure? 1 crore 10 lakh. Correct, no people? Of the shop part she can claim. Okay, 1 crore 10 lakh is the total cost. There are two floors. One floor is used for shop, another floor is used for the self residence. For self residence, she cannot claim any depreciation. But for shop, can she claim it? Yes, she is the owner. No, she is the boss. So she can claim depreciation. This is also important because you might miss out this. On residential house used for a shop, which is 1 crore 10 lakh, into take 50% of it. That is for one floor into 10%. Clear? And please be careful. Here 50% is not for less than 180 days. No, no, no. Sir, this is for only shop we are taking. 50% is like one floor. Take only that. Okay. Then on electric vehicle, the depreciation rate is 40%, guys. So claim depreciation. So finally, you will get PGBP income as 1,51,250. Next, coming to capital gains. Take simply straight sale value, deduct cost of acquisition, guys. This short term, so no question of indexation and all. Clear? Yes, sir. So short term capital gain taxable under section 111A is 9 lakh 1,000. And sir, why it is short term? Because the shares was held for less than 12 months, guys. Less than 12 months. So is it a special income? Yes, covered under section 111A. Then coming to income from other sources. Family pension from public sector undertaking 3,60,000. For this, there is a deduction available. Guys, please be careful. What is the deduction for family pension under default regime? One third of actual pension or 25,000, whichever is lower. Whichever is lower. So one third of 3,60,000 or 25,000, whichever is lower, you will get 25,000. Remaining is taxable. Then coming to dividend income. Guys, dividend is given net. We need to gross it up. How is it, sir? 4 lakh 50 divided by 90%. Sir, how did you get this 90%? TDS rate is 10%. That is 100 minus 10%. Got it? Yes. So this is nothing but what we have received. Yeah. Yes, sir. So we grossed it up to 5 lakh. On this, can we claim the expenditure? Yes. Guys, they have just mentioned expenses. They didn't mention interest. But here they have assumed it to be interest expenses. Okay, in the answer, while giving the suggested answer, they assume that it is an interest expenses. If by chance, if the same thing happens in your exam also, if they are given only expenses on dividend, you can assume it to be interest expenses and give a note for it. Clear? Yes. So, is it fully allowed? No, sir. Actual interest expenses or 20% of dividend income, whichever is lower. 20% of dividend income comes to how much? 1 lakh. Actual interest expenses is how much? 12,000. Claim 12,000. Claim 12,000. So taxable is 4 lakh 88. Then interest on FD, gross only is given straight away. This TDS is not deducted on this. Straight away take 76,000. So income from other sources is how much? 8 lakh 99,000. Okay, sir. So gross total income is 19 lakh 51 250. No deduction under chapter 6A for assessee who is following default regime. So nil. What is the total income? 19 lakh 51,250. 19 lakh 51,250, guys. Got it? Yes, sir. Now coming to optional tax regime. Let us take the gross total income itself as a base year and make necessary adjustments. Guys, when you are making necessary adjustment, just go back and observe what and all we need to change. What and all we need to change. Okay, now interest is allowed. Interest on self-occupied property, half of whatever is the interest, half of it, is it allowed under the optional scheme? Yes, sir. One change. Next. Yeah, this is allowed under optional scheme. This is allowed. What we disallowed under default regime, this is allowed. Next, family pension deduction also, guys. Okay, this and all would remain same. Sale consideration, this is fine. Family pension under optional scheme, it is not 25, it is 15. One third of actual pension or 15,000, whichever is lower. Hope you got it. Plus deductions. Deductions and all will anyway come after gross total income. Got it? Yes. So these are the necessary adjustment which we need to make. Interest on borrowings for self-occupied property, which is 1,68,750. Guys, this is nothing but loss from self-occupied property. Sir, can we adjust the loss from self-occupied property against other incomes? Yes, maximum 2 lakh. Under optional scheme, you can do it. Other rates you can adjust. Maximum 2 lakh. And here it is within 2 lakh. Clear? Actually, they have not shown all that. Better you show. This actually is nothing but loss from house property. Clear? Which you can adjust it against other rates. Then 100% deduction under section 35 to AA for amount paid to IIT Chennai. This is under the PGBP, guys. Now allowed. Previously under default regime, we disallowed it. Next, excess deduction. Guys, under default regime, the flat amount was one third of the family pension or 25,000. Whereas under optional scheme, it is 15,000. 15,000 or one third of the family pension, whichever is lower. So extra 10,000, whatever we had claimed, we are adding it back. Clear? Yes, sir. So we will get gross total income as per optional scheme. 17 lakh 57 500. Now under optional scheme, can we claim chapter 6A deductions? Yes. So what are those? Deduction under section 80QQB, that is for royalty income. Guys, royalty income is 3 lakh 50,000. How is it, sir? Remaining. Because 425 is the amount received, 75,000 expenses you already claimed. I will just show you. Because this is anyway same treatment under both the schemes. It was under IFOS, correct? Sorry, not PGBP. They have treated it under the head PGBP. Listen, I will show it in this because they have only made the adjustments. 425 minus 75. Both they have taken it under the head PGBP. So remaining is how much? 3 lakh 50. 3 lakh 50. Hope you are getting it. Can we claim deduction for full 425? No, sir. Clear? Yes. So 425 minus 75 as. Royalty, as I already mentioned, you can alternatively be considered under IFOS also, guys. Nothing wrong. Answer would remain same. Sir, will they deduct any marks? No, they only told. No, alternatively, you can consider it under the head IFOS. Okay. So 3 lakh 50 is remaining, but maximum deduction under section 80QQB is 3 lakh. Maximum you can claim is 3 lakh. So you can claim only 3 lakh. Next, deduction under section 80TTP. Assessee is a senior citizen. Assessee is a senior citizen. So can she claim deduction under section 80TTB, sir? Yes. 80TTB is alive. So even though it is a FD interest, can she claim deduction for it? Yes. How much? Maximum 50. Maximum 50, guys. Sure. And in the question they have given, TDS is not deducted. Will it impact any answer? No. Will it have any impact on the answer, guys? No. Or maybe the such expenses will be disallowed to the payer. Okay, because TDS is not deducted. Whereas for the receiver, no problem, sir. Anyway, she has disclosed. Not a problem. If it is assumed that FD are not with the bank's cooperative society engaged in banking business or post office, then deduction will not be available, guys. Because 80TTB deduction is available only for the interest on deposits with bank, cooperative bank, and post office. They have not mentioned in the question FD is with whom. You have assumed that as the FD is with either bank or cooperative bank and post office, and deduction is claimed. Maximum 50,000. So here total income we are getting how much? 14 lakh 7,500. Let us proceed further. Question number 2, guys. 2A first. State with reason whether income chargeable to tax in India for the assessment year 25-26 in the hands of recipients in the following independent situations. First one, Mr. Mahesh received a dividend of 7 lakh declared and paid by a foreign company outside India. Such dividend has been declared in respect of shares which derive their value substantially from the assets situated in India. See, this is actually derive the value substantially from the assets situated in India and all is a part of your final syllabus actually. They ask the question at intermediate level. Is resident and not ordinary resident in India. They have given out of syllabus. Thank you. One more error. Okay, because this is a part of final syllabus. Yeah. So anyway, it's not a part of your intermediate syllabus. Let's not waste discussing it. Okay. Mr. Shivans is a non-resident in India and residing in China has deposited 16 lakh with ABC Limited, an Indian company, on 1st September 2024. He has received interest at 12% per annum in China during the previous year 24-25. Guys, the question is on interest. Interest is received by whom? Non-resident. And who is paying it? Mr. Shivans is a non-resident in India and residing in China and has deposited 16 lakh with ABC, an Indian company. Who is the payer? Who is paying interest? Indian company. Indian company will always be resident in India as per section 6.3. Artha aita? Yes. Who is paying interest to whom? Resident to non-resident. When resident is paying interest to non-resident, it is deemed to accrue or arise in India for the receiver. But it is not deemed to accrue or arise in India only if the amount is used outside India for any business or profession or for earning any income outside India. Where is this income or money is used, sir? Whatever money ABC Limited has borrowed, where they have used it, sir? Sir, it is an Indian company. So it is understood that it is used in India. Clear? Yes, sir. So whatever interest they will pay for the receiver, that is Shivansh, is it income deemed to accrue or arise in India? Yes. Is it taxable? Yes. Irrespective of its residential status, when income is deemed to accrue or arise in India as per section 9, it is always taxable. It is always taxable in India. Hope you understood. This is a case where non-resident has paid interest. Sorry. Resident has paid interest to non-resident. Clear? If you guys remember, just a minute, I will show you in our chart where it falls. Under scope of total income while discussing section 9. Yes. Just yes, you can see the receiver will always be as per this non-resident. Who is the payer? Person resident in India in this case. In that case, generally taxable. But if it is used outside India for any business or profession or for earning any income outside India, then it is not income deemed to accrue or arise in India. So here, as it is an Indian company, we are assuming the money is used in India. Is the interest taxable for the receiver? Yes. We will look into the answer. Yeah, this is wrong. Interest on deposit with ABC Limited, an Indian company, would be deemed to accrue or arise in India in the hands of Mr. Shivansh, being a non-resident, since source of income is in India. You can also elaborate and tell, since it is income deemed to accrue or arise in India as per section 9. As per section 9. Thus, interest income of 1,12,000. How did we get it? Loan amount into interest rate into 7 by 12. Why 7 by 12, sir? Because loan was given in between the year. That is on 1st September. So from 1st September to 31st March, you have to count. Yes, sir. 7 months, guys. So 7 by 12 would be taxable in his hands. Okay. Next case. Third one. Mr. Ramesh received a royalty of 8,25,000 in consideration of providing patent rights to Mr. Sunil. Mr. Sunil has developed a new product in India. Where is the patent right used? In India. By utilizing the patent rights, 30% of the royalty was received in India and 70% was received outside India. It doesn't matter, guys. Mr. Ramesh and Sunil both have status of non-resident. So non-resident to non-resident case this is. Clear? In this table, where it falls, sir? Last category. Receiver also non-resident, payer also non-resident. But it is income deemed to accrue or arise in India for receiver if the patent is used in India. Is used in India. In the given case, is it used in India? Yes. Complete royalty income is deemed to accrue or arise in India for the receiver. A part of the amount is received outside India. It doesn't matter. When it is income deemed to accrue or arise in India, irrespective of your residential status, it is always taxable in India, guys. So the answer is taxable. Royalty received by Mr. Ramesh, a non-resident, from Mr. Sunil, another non-resident, would be deemed to accrue or arise in India as per section 9. Better mention that section. As per section 9. Since such royalty is paid for a patent right used for a new product developed in India, where is the money or services used is important. Okay, to decide whether it is income deemed to accrue or arise in India, the money, whatever is lent, or the services, whatever is given, where is it used is important. If it is used in India, then it is income deemed to accrue or arise in India, guys. Is it clear? Yes. Thus, 8,25,000, that is full amount, guys, would be taxable in the hands of Mr. Ramesh, irrespective of the fact that only 30% of such amount is received in India. Oh, next. B. Discuss the relevant provisions of Income Tax Act 1961 with respect to tax deduction at source, that is TDS, and calculate amount of TDS also for assessment year 25-26 in the following independent situation. Means you need to tell whether TDS is applicable or not. If it is applicable, then how much? Then how much? Oh. Marks Pictures Limited is a movie and short films production house having turnover of 15.22 crores during the previous year 23-24, that is last year. Oh. Solar Varanasi LLP also produces short films and clippings, and it has already produced a short film namely Mahakumbh. On 16th October 2024, Marks Pictures Limited acquired television rights. They acquired television rights in consideration for 52 lakhs from Solar Varanasi LLP. Both have valid PAN. Guys, is TDS applicable on this? Yes. And see, you might get a doubt. Sir, is it under 194C or 194J? It is 194J. 194J, guys. Yes. Payment made by Marks Pictures Limited for acquisition of television rights of content already produced by the Solar Varanasi LLP, a production house, would not be liable for tax deduction at source under section 194C. Why, sir? Because there is no contract for carrying out any work as required in section 194C. Because 194C is applicable only if there is a contract to do any work. Have I given a contract for you to shoot a film and then I will purchase for you? No, no. They have already shoot the film. We are buying it from television rights. Correct? Yes. However, consideration for acquiring television right in respect of film would fall within the definition of royalty as defined in explanation 2 to section 916. Accordingly, TDS would be applicable under which section? 194J. At what rate, sir? 10%. 10%. So 52 lakhs into 10%, 5 lakh 20,000. One important thing to note here is, just a minute, I will show you. You can come to TDS chart. Yes. See, first, why 194C is not applicable, I will show. Just a minute. 194C. Why it is not applicable? Because they clearly have told here. One second. Yes. They have clearly told 194C is applicable only for contract of work, guys. Contract of work. You can see here. Any residential contractor for carrying out any work, including supply of labor. So there is no contract work here. Okay. Coming to 194J. 194J. Now, you might have a confusion. Sir, is it 2% or 10%? See, 2% is there. Where? I will mention here. Look here, please look here. Royalty in the nature of consideration for sale, distribution, or exhibition of cinematographic films. So if it is the distribution right to display the movies in the theater, then it would have been 2%. But what is taken here is television rights. So for that, what would be the rate applicable? 10%. It would be 10%. Hope you understood. Next. Next, second part here. Second one, Mr. Mayank, a salaried individual, paid rent for his residential house at Mumbai to the house owner, Mr. Nikhil, in the following manner. From April to September, 75,000 per month. And from October to March, 1 lakh per month. Guys, it is 50, more than 50,000 per month. Is TDS deductible? Yes. Even though he is a salaried individual, tax audit might not be applicable in the last year. But still, is he a payer? Yes. Because the monthly rent is more than 50,000. More than 50,000. So, should TDS be deducted? Yes. But one speciality of this section is TDS should not be deducted every month. It should be deducted only in the last month of the previous year. And you can observe here, the property is occupied throughout the year. There is no vacancy. Is the tenant vacating the property? No. So when TDS has to be deducted? Last month of the previous year, but for the full year. But for the full year. Observe this. Since Mr. Mayank pays rent exceeding 50,000 per month in financial year 24-25, he is liable to deduct tax at source under section 194 IB. Please be careful. There are two sections for rent. There are two sections for rent. Just a minute. 194I, is it applicable? No, it will not cover the individual who is not subject to tax audit last year. So here we are not applying 194I. Which section are we applying? Sir, we are applying 194 IB, where monthly rent is more than 50,000. What is the TDS rate? If it is still 30th September, 5%. On or after 1st October, 2%. Guys, when the tenant would be deducting TDS? Last month of the previous year. Last month means 31st, means March. In March, what is the TDS rate? 2%. So 5% should be deducted or 2%? 2%. That is at the time of deducting TDS. What was the rate? Deduct at that much. Deduct at that much, guys. Yes. Let me read this. Since Mr. Mayank pays rent exceeding 50,000 per month in financial year 24-25, he is liable to deduct tax at source under section 194 IV at 5% till 30th September, and thereafter, that is from 1st October, 2%. The tax is to be deducted in the last month of the previous year, that is March, or in the last month of tenancy, that is if he is vacating the property in between. If the property is vacated during the year, since property is not vacated during the year, 21,000, that is 10 lakh 50,000. How did we get it, guys? Simple. 75,000 for 6 months, 1 lakh for 6 months. Add up both for full year. You need to add up for full year into 2%. Into 2%, which comes to 21,000. So 21,000 has to be deducted in March month. Clear? Please be careful. In March month, it has to be deducted, but not only on March month rent. It is for the full year rent. Okay, sir. Chalo. Question number 3, guys. Question number 3. Mr. Sandeep, manager in CTL Private Limited at Mumbai, furnishes following information for the year ended 31st March 2025. Basic salary is 55,000 per month and entitled to a commission of 2,500 per month. A company owned accommodation is provided to him in Mumbai. Company owned accommodation in Mumbai. What is the population in Mumbai? More than 40 lakh. What is the perquisite value? 10% of salary. 10% of salary, guys. And for salary, should we take commission? Yes. No matter which commission it is, you have to take. You have to take it, guys. Just a minute. I will show it. Salary head. Yes. You can observe. If the accommodation is owned by employer, then check the population. If the population of the place where the accommodation is provided as per 2011 census is more than 40 lakh, we need to take 10% of salary. And here what is salary, sir? Salary means basic pay plus DA forming part of retirement benefit are provided in terms of employment plus bonus plus commission. For commission, no condition. No condition. So in our case, should we take basic pay plus commission both? Yes. 10% of it. 10% of it, guys. Okay. Furniture costing 2,40,000 was also provided. So assuming it is owned by the employer, guys, we need to take 10% of it. We need to take 10% of it. It took a personal loan of 3 lakh on 1st September 2024, on which interest at 7.75% per annum was charged by the company. This is actual interest charged. The entire loan is still outstanding. SBI rate of interest on 1st April 2024 is 12.75. This is the base rate, guys. So there is a concessional interest charged by the employer. How much, sir? 5%. The difference between this. So 3 lakh into 5% is taxable. For how many months? From 1st September to 31st March. As what, sir? Perquisite. As perquisite. Yes, sir. Because interest is charged at a lower rate. Mr. Sandeep is the owner of house property in Kolkata, which he constructed during the financial year 1617. The property consists of 4 identical units. Okay. It was constructed in 1617. It has 4 identical units. Means you can consider it as 4 houses. Okay. He occupied 1 unit for his residence, so self-occupied, and the 3 units were let out at a rent of 20,000 per month per unit. Per house, 20,000. Guys, please be careful. House property. Income from house property. The municipal value is 9 lakh and municipal tax was paid at 20% of municipal value. And municipal value they didn't give. Is it unit wise or is it for the entire property? What do you consider? Entire property. Entire property, guys. Then fair rent and standard rent 7 lakh 50 and 8 lakh 50 respectively. Please consider it for all the 4 units put together. Clear? So please be careful. One of the unit is self-occupied. We cannot take it for it. You need to consider only for the remaining 3 units. One of the let out units was vacant for 6 months during the year. Interest on loan taken for construction of the house is 2 lakh, guys. Okay. For interest deduction can be claimed. One of the let out units was vacant for 6 months. So we need to consider loss due to vacancy. Loss due to vacancy. Compute total income of Mr. Sandeep for assessment year 25-26, assuming he has opted out of default tax regime. One more question on total income. Main target here is salary and house property. Clear? But still they have asked for total income. But under opted out of default, that means he is following optional scheme. 6 marks question. Sure. First, let us calculate salary. Basic pay and commission, both. Per month is given, do into 12. Into 12. Then rent-free accommodation, I told you guys, 10% of salary. Now, what is salary, sir? 6 lakh 90,000. 6 lakh 90,000. Should we take commission? Yes. Sir, it is not expressed as a fixed percentage of turnovers. No, sir. Yes, still you have to take it. For perquisite calculation, they didn't put that condition for commission. Okay? Yes. So take 10% of 6 lakh 90,000. You will get 69,000. Plus, even furniture is provided. Take 10% of the cost of furniture. So perquisite value of furnished accommodation is 93,000. Then coming to loan part, guys. Loan part, what they have done is they have taken actual interest, sorry, SBI interest and deducted what is actual interest charged by the employer. But what you do is straight away you can do like this, guys. 3 lakh into take SBI interest rate minus actual interest is how much? 7.75% into how many months? 7 by 12. 7 by 12. Please be careful. Loan is given in between the year. From the date of loan till 31st March, you have to count. Clear? Yes, sir. So, what they have done is they have taken first SBI interest rate, then they have reduced that interest rate charged by the employer. Remaining is taxable, which actually comes for 5%. 5%. That is called concessional interest rate, guys. You will get gross salary. From gross salary, even if question is silent, please give for standard deduction. Under optional scheme, what is the standard deduction? 50,000. Deduct it. Remaining is income from salary. 7,41,750. Okay, sir. Then income from house property. Income from house property. Let out portion. 3 units are there. Guys, for this, please pay attention. Important. Municipal value, fair rent, standard rent is given for full house. That is what we should assume. Okay. So we need to take only 3 by 4 of it. 3 by 4 because another 1 by 4, that is 1 unit is used for self-residence. Okay. First, municipal value or fair rent, whichever is higher. Compare that with standard rent. Take whichever is lower. So you got expected rent. You got expected rent. Then you calculate actual rent. Actual rent is how much, sir? 20,000 for each unit per month. So 20,000 into 12 into 3 units. But there is a loss due to vacancy for 6 months for 1 unit. So 20,000 into 6. This is loss due to vacancy. Guys, this is actual rent. Correct? Should we compare straight away actual rent with the expected rent? No. When there is loss due to vacancy, you need to compare the actual rent plus loss due to vacancy. Plus loss due to vacancy would be how much, guys? 1 lakh 20, yeah? 1 lakh 20. 1 lakh 20. It would be how much? 7 lakh 20. Artha ಆಗ್ತಿದ್ಯಾ? Actual rent plus loss due to vacancy. Compare that with expected rent. Sir, 7 lakh 20 is more than 6 lakh 37 500. What is the what is the gross annual value now? Actual rent. What would be the gross annual value? Actual rent. Hope you are getting it. So this is our gross annual value, guys. Hope you understood. If you want, I will just show it quickly. 1 second. We need to go to income from house property. Yeah. See, when there is a vacancy, what should we do, sir? Compare expected rent with not straight away actual rent. Actual rent plus loss due to vacancy. See which side is more. Sir, if expected rent is more than actual rent plus loss due to vacancy, what is the gross annual value? Expected rent would be the gross annual value. Got it. Sir, what if expected rent is less than or equal to actual rent plus loss due to vacancy? Then actual rent would be the gross annual value. Actual rent. And please be careful, while calculating actual rent, you would have already reduced loss due to vacancy. Clear? Again, are we adding and taxing it? No, no. Only for comparison, we are adding loss due to vacancy. That's simple logic. Expected rent will be for only let out period or for full year. Full year. So that is why we are adding actual rent to loss due to vacancy and comparing each other. Because when we are comparing two figures, it should be for common base. Correct? Now, because actual rent will be only for let out period, whereas expected rent will be for full year. Can I straight away compare both? No, sir, not fair. So that is why only to compare, we are adding loss due to vacancy. If there was no vacancy, how much rent you would have got? Compare that with expected rent. Clear? Whereas if this side is more, we cannot tax you this because this is a loss. So what are we taking it as a gross annual value? Only actual rent. Okay, sir. Coming back. So municipal tax paid, you need to take only on lettered portion. What is the municipal value of lettered portion? 6 lakh 75. Don't take it on 9 lakh because that also has self-occupied portion. So on 6 lakh 75, take the percentage, which is 20%. This is the municipal tax paid for let out portion, 1 lakh 35,000. Put it in bracket. Next, you will get net annual value. 30% of that is allowed as a deduction. Then interest on loan. 2 lakh is there, but take only 3/4 of it. Remaining 1/4 is for self-occupied portion. Okay, sir. Fine, basics. So you will get 2,89,500 total deductions under 24. So put it in bracket. So income from let out portion is 1,75,500. Coming to self-occupied portion, annual value is nil for that always. So straight away go and calculate interest. 2 lakh is the total interest. In that 1/4 is for self-occupied portion because it is one out of 4. Okay. So what is the loss from self-occupied property? 50,000. Sir, can loss be set off against income from house property? Yes, within the same head you can adjust it. So what is the net income after adjusting the loss? 125,500. So if I add it to salary income, where is our salary income here? Yes, 7,41,750. You will get a gross total income or total income of 8,67,250. Question is silent about deductions and all, and moreover, which scheme the assessee is following? Optional tax regime. Under optional tax regime, he will be eligible for deductions under Chapter 6A, but question didn't give any information about deductions. So we will assume deduction to be 0. So gross total income is equal to total income. Okay, so second part here, which is for 4 marks. Discuss the taxability with reason in the hands of recipient for assessment year 25-26 in respect of the following receipts or income. Mr. Ram received a sum of 5 lakh from his father on Ram's wedding anniversary. From father, guys. Father. Relative, no, not taxable. Wedding anniversary is not an event. See, wedding exempt. Wedding anniversary is not exempt, but received from whom? Father, no. Exempt. Not taxable. Sum of money exceeding 50,000 received without consideration by Mr. Ram from his father is not taxable under section 56 to 10 since the sum is received from a relative, that is the father of Mr. Ram. Okay, so next Mr. Govind sold his house property to Mrs. Radha for 1 crore 25 lakh, whereas the value determined by Stamp Valuation Authority was 1 crore 75 lakh. Guys, what is the inadequate consideration? 50 lakh. 15 lakh. Check it. Is it more than two things? Inadequate consideration is how much? 50 lakh. So take 10% of actual consideration. 1 crore 25 lakh into 10%. Okay. Compare that with 50%. Sorry, 50,000. Whichever is higher you take. Whichever is higher. So 1 crore 25 lakh into 10%. Compare that with 50,000. Take whichever is higher. Compare that with 50 lakh. 50 lakh is more than that. Correct. So is entire 50 lakh taxable? Yes. Entire 50 lakh is taxable in the hands of recipient because it is a purchase of immobile property for inadequate consideration. Yes. The difference of 50 lakhs between stamp duty value of rupees 1 crore 75 lakh and actual consideration of 1 crore 25 lakh is taxable under section 56 to 10 in the hands of Mrs. Radha since the difference exceeds 12 lakh 50,000. What is this 12 lakh 50,000? 10% of actual consideration. That is 1 crore 25 lakh or 50,000, whichever is higher, 12 lakh 50. This 12 lakh 50 we need to compare with what? Inadequate consideration. Inadequate consideration 50 lakh is more than 12 lakh 50. So is it taxable, sir? Yes. So 50 lakh is taxable in the hands of Mrs. Radha. 1 lakh 1 crore 75 lakh is to be considered as deemed sale consideration for the purpose of computing capital gain in the hands of Mr. Govind. So for Govind, actually they didn't ask, they asked only for recipient, but they have mentioned here. For Govind, if you have to compute capital gains, as per section 50C, what will be the full value of sale consideration? 1 crore 75 lakhs. Because 1 crore 75 lakh is more than 110% of actual sale consideration. So what would be the full value of sale consideration to compute capital gains income for Mr. Govind, that is the seller? 1 crore 75 lakhs. Okay. Last one. Miss Agastha got a gift of car worth 7 lakh from her friend on her wedding anniversary. Guys, car is not covered in property definition. Under section 56 to 10, there are totally three kinds of gift. Cash, other is property. Under property, two categories. Immobile property, movable property. Immobile property means land or building. Movable property, only specific assets are covered, like shares, jewelry and all. I will just show you. Pay attention, pay attention. Look here. Yes. So this is for gift purpose. Okay. 56 to 10. Okay. Sir, what is property for this purpose? What is property? I've covered it here. Property means the following capital asset of the assessee, namely, first one, immobile property being land or building or both. Okay. Next, shares or securities, jewelry, archaeological collection, drawings and paintings or sculptures, any work of art or bullion. So this are considered to be movable property. So in this, is car involved? No, sir. Car is not involved. So even though car is received, even though value is more than 50,000, is it taxable? No, sir. It is not taxable. It is not taxable. Even though it is more than 50,000, still not taxable because it is not covered in property definition for 56 to 10. Non-taxable. Car is not included in the definition of a property for the purpose of section 56 to 10. Therefore, car received by Mr. Agastha for her from her friend is not taxable because car is not a part of property. Next, question number 4 under that A. Mr. Sanju, an individual associate aged 32 years, furnishes the following details for the year ended on 31st March 2025. Loss from future and option 75,000. Guys, future and option is not speculation. It is not speculation. It comes under derivatives. Derivative is not a speculation. So it is a normal business loss. Please be careful. This is a normal business loss and not speculation business loss. Got it? Yes. Profit from restaurant business computed 2,21,000. Share of profit in partnership firm Excel and Co. 19% share is there. 38,000. Guys, share of profit received from partnership firm is actually exempt. Interest, salary, bonus, commission and all is taxable in the hands of partner under the head PGBP. Whereas share of profit is exempt. Share of profit is exempt. Then income from salary, which is already computed, 3,15,000. Interest on loan paid for self-occupied house property, 1,75,000. Principal amount paid is 1 crore. Okay. Short-term capital gain, 82,000. Long-term capital gain under section 112A, 1,10,000. Long-term capital loss, 68,000. Sir, it is under section 112. Can I adjust it against long-term capital gain under section 112A? Yes, you can do it. Long-term loss can be adjusted against long-term gain under any sections. Okay? Yes. His wife received a salary of 2,40,000 from a partnership firm, Excel and Co., where she is an accountant. She does not have any professional qualification relating to accounting. Abu Dhabi. No qualification. She is getting salary. Okay. From where? From partnership firm. In partnership firm, how much Sanju is holding? 19% share. Not a substantial holding. Not a substantial holding. Will clubbing get attracted here? No, sir. No clubbing. If it was a substantial holding, then clubbing would have been attracted. As per section 64, subsection 1, guys, if spouse is working in an entity in which the other spouse has substantial interest, and if the spouse is receiving any salary without any qualification, experience, knowledge, then it would be clubbed with the spouse who is having substantial interest in the company or partnership firm. 19% is not substantial interest. Okay, it is 20% or more, guys. Is it clear? So as there is no substantial interest, no clubbing. No clubbing. Okay. Next, he paid 21,000 for medical insurance premium and 9,000 for preventive health checkup. Guys, for himself, let us think for himself and family. 21 plus 9. Can he claim both? No. Maximum for preventive health checkup, how much? 5. So 5 plus 21 comes to 26, but restricted to 25. Understood, na? Yes. Brought forward speculative business loss, 26,000. This being the third year from the year of loss. No problem. This is the third year. He cannot set up in the current year also. Why? He doesn't have speculation business income. Can he carry forward for one more year? Yes. Maximum speculation loss can be carried forward for 4 years. This is the third year. One more year he can carry forward. And he can adjust it only against speculation business income. And guys, please be careful. You might get confused with this. This is the income from derivative. Derivative is not a speculation. Clear? Yes. Next. And brought forward short-term capital loss, 52,000. This being fourth year from the year of loss. No problem. Totally, you can carry forward short-term loss for 8 years. Short-term loss can be adjusted either against short-term gain or long-term gain. Okay. I guess we have short-term gain. We can adjust it. Okay. Next, compute total income of Mr. Sanju for assessment year 25-26 if he exercise the option of shift out of default tax scheme. That means he's following optional scheme. Also state the losses eligible to carry forward. That is for next year. Okay. Let us do it. Computation of total income of Mr. Sanju for assessment year 25-26 as per the optional tax regime under Income Tax Act 1961. First one, salary computed already given in the question, straight away take it. 3,15,000. And here they have given a note telling clubbing is not attracted. Clubbing is not attracted. Salary received by his wife from Excel and Co partnership firm of 2,40,000 shall not be clubbed in the income of Mr. Sanju, even if his wife does not have any professional qualification, since he does not have substantial interest in the firm, as his share of profit in such firm is less than 20%. No clubbing. Clear? But see, if at all if clubbing get attracted, it will get attracted under other sources. Clear? But this is not the right place to give note. Better you give it later. Okay, maybe you can give it under IFOS or maybe under your answers at the end. Separate. Clear? Yes. Next. Loss from self-occupied house property. Sir, can it be adjusted against salary income? Yes, you can adjust it. Under optional scheme, yes, assessee can adjust house property loss against other rates, but maximum 2 lakh. Maximum 2 lakh. Here it is anyway 1,75,000. Adjust it. Not a problem. Clear? But if it is under default, you cannot. First of all, if you are following default, you cannot have loss from self-occupied property. Why? When can you have loss from self-occupied property? Only if you have interest. Interest under default regime is blocked. If interest is blocked for self-occupied property, income from self-occupied property under default regime will always be nil. No question of having loss. Got it? But still, in this case, assessor is following the optional scheme. You will have a loss, and can you set it off against other heads? Yes. Okay. Actually, they are calculated here, but adjusted above only. Oh, chalo. They have shown here interest on self-occupied property 1,75,000. So they will have a loss. Guys, instead of taking it above, you can adjust it here only, no problem. And give a note telling current year house property loss can be adjusted against salary head to the extent of maximum 2 lakh. Got it? No? Yes, because they have calculated here, then they have gone and adjusted here. Okay, so what you do is straight away take salary income here to the outer column, and here put 175 in negative. Clear? That would be fine, but just give a note telling yes, it can be adjusted. Profit and gains of business or profession 2,21,000 is the profit. Loss from future and option, can we adjust it? Yes, it is a normal business. Better mention there, normal business. It is not a special business. There are only two special business for loss adjusting under the head PGBP. What are those? Speculation and specified. This will not fall under both. So you can adjust it. 146. Then share of profit is exempt, guys. As per section 10 2A, share of profit received from partnership firm is exempt. Please be careful. Interest, salary, bonus, commission, remuneration is taxable for the partner, but not share of profit. Okay. Capital gain. Short-term gain is there, 82,000. Brought forward, short-term loss is there, which is given in the adjustment. Can we adjust it? Yes, short-term loss can be adjusted again. Short-term gain. So remaining, take it to the outer column. Then long-term gain under section 112A is there. Can we adjust 112 loss against 112A? No problem. Any long-term loss can be adjusted again. Any long-term gain. Okay, sir. 68. Remaining is what? 40. Okay, sir. And please be careful. Sir, 42, no, sir, less than 125. So I will remove it. No, no, no. Only while calculating tax on this, it would be 0. Correct. Why, sir? Because this is 120 again. Up to 1,25,000, it is not tax. But while computing the income, please include whatever is the income. Only while calculating tax, you will not calculate tax up to 1,25,000. Okay, sir. Then gross total income we are getting 3,58,000. Repayment of housing loan can be claimed as deduction, that is principal repayment under section 80C. Then 80D, I told you 21 and 9 is restricted to 5. So 21 plus 5 comes to 26, but is restricted to 25, maximum 25. Clear? Yes, sir. So it comes to total deduction 145. Put it in bracket. So total income is 2,13,000. They have also told which losses can be carried forward. They have asked that. Loss from speculative business. This is the third year. You have another 1 year, carry forward it. But you can adjust it only against speculative business income. That's all, guys. Short-term loss was there, which we have adjusted here itself, brought forward. And current year long-term loss we have adjusted here. Current year house property loss also we have adjusted here. Nothing to carry forward. Nothing to carry forward. Okay, sir. Then we have theory question. What it is, sir? State persons who are required to apply for allotment of PAN under section 139A subsection 1 of the Income Tax Act 1961 mention the time limit for making such application also. So PAN is covered under section 139A. They are telling who should apply for PAN within what time. Within what time, guys? You need to just explain this provision. Just a minute. I will show you. Yes. You need to just apply. You explain these provisions, guys. Okay. Two scenarios are there here. First, you need to explain all this. And if in all these cases, PAN has to be applied within this time limit. Same way, sir, even in this cases, should we apply for PAN? Yes. Within what time? Within this time. You need to just explain this provisions. So I will just show you the answer, whatever they have presented. They have copy pasted my material actually. Check. You can see the first four cases here. Okay. Then also the next three cases. The next three cases means this one. Clear? Yes. Sure. Next one. Next question, I guess, is on Aadhaar. Aadhaar. Specify all the documents in which quoting of Aadhaar number is mandatory under section 139AA of Income Tax Act 1961. Also explain to whom provisions of section 139AA does not apply. There are few exceptions. Guys, easy to remember 139A and 139AA. PAN has one A in between, correct? So 139A. Aadhaar will start with double A. 139 double A. Okay. Chalo. So which provision should you explain? Aadhaar, no? Aadhaar is here. So where and all you have to quote your Aadhaar in the application for PAN as well as income tax return. As well as income tax return. Sir, when these provisions are not applicable, I have given it here. In the following cases, the quoting of Aadhaar is not mandatory. Okay, na? Yes, sir. This is what the answer is. And there is an internal choice in between this. Okay, you have to answer any one. You can see this is the answer, guys. That's all. The second part is GST, which we will see later. Got it? Yes. So this is the direct tax component from May 2025 question paper, guys.